For a generation of young adults with 2 cents in their pocket and a $200,000 student loan for a degree they don't use, investing in stock markets may seem like a foolish idea. But when done correctly, you can transform that 2 cents into 3 cents, which is more than what you had yesterday. And isn't that the point? In any seriousness, the stock market is frequently portrayed as a huge, terrifying hole of money that devours naive investors while also providing a road to massive fortune for those who understand it. While such views may be accurate, knowing the stock market and succeeding and profiting from it is considerably simpler than one would think. And to comprehend the stock market, we must first comprehend the concept of a stock. We'll go through the fundamentals of the stock market, how it works, and how to get started with today's video. But first, if this is your first time at the Smart Stocks Academy channel, let me give you a warm welcome. Don't forget to hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is produced. So if you're ready, let's go about talking about stocks. A stock, also known as a share, is a financial symbol or instrument that represents partial ownership of a corporation. For example, if Amazon had 1,000 shares and you bought one, you would own 1,000th of a company. Well, in actuality, Amazon and other corporations have millions of shares, but this illustrates the concept. So, when you buy a stock, you are buying a piece of the firm, and as the value of that firm rises, so does the price of your shares. There are also ordinary and preferred stocks, which pertain to a shareholder's voting rights. Preferred shares do not have voting rights, but regular shares do. You can vote on board elections, mergers, and other financial decisions if you have voting rights. Preferred shares, on the other hand, are so named because they have the first priority when a firm pays a dividend, which is essentially a split of a company's earnings with its shareholders. And they also have first priority in other financial situations. Stocks may grow a lot more intricate than that, but for the average investor, these fundamental concepts will suffice. The second question you would have is why corporations sell stocks, and the answer is simple: to make money. Stocks enable a corporation to generate large sums of operational cash with no additional labor or product. So in today's stock market, a company's worth is frequently determined by its projected earnings in the future. This means that relatively small businesses can make millions, if not billions, of dollars if investors believe they will succeed in the future. So, if a company wants to sell its stocks, they must go to the stock market. Companies list their shares on an exchange by selling them in an initial public offering or an IPO. This effectively transforms a firm from a privately held to a publicly traded one. IPOs allow company founders to sell their shares or simply allow the company to raise funds. The public can trade a company's stocks after they are listed on an exchange. Prices will normally fluctuate in response to public opinion, but more definite patterns and variations are usually determined by a company's revenues and activities. PE ratios, or price-to-earning ratios, as well as a range of other indicators may be used to assess them. This is normally where inexperienced investors become afraid and their eyes glaze over. But do not worry, it is not as complex as it appears. Next, we must comprehend how and why stock prices swings. The stock market is made up of millions of investors and traders who all have distinct perspectives on a firm. They all make their own decisions, and the sum of their decisions determines whether a stock moves up or down. If more people buy, the price will have to rise. When everyone wants out of a company, the price drops due to a lack of demand. Consider the following scenario. You want to sell something on Craigslist for $100. You get 100 emails after posting stating they will come to buy your goods for cash right now. Most individuals will begin to believe that they have priced their item too low at this stage, and will raise their price until it hits the theoretical maximum that a single final customer will pay for it. And if you don't get any bids, you probably keep lowering the price until someone does. This is similar how the stock market works, except the price rises and falls are caused by millions of transactions every second. Supply and demand. Which brings us back to our original topic. There must be a buyer and a seller for every stock purchase or sale. The price will rise if there are more buyers, while the price would fall if there are more sellers. The bid-ask spread is a term used by traders to describe the difference between the bid, or what someone is prepared to pay to acquire a share, and the ask, or what someone is willing to sell a share for. At the end of the day, supply and demand is a rather straightforward concept to grasp. If there are more individuals interested in something, example a stock, it will be more costly. Matching buyers and sellers on a trading floor was done manually at the outset of stock markets. Trading systems now do the majority of the work for us. This permits the market to move considerably faster, resulting in the dizzying pace that every casual observer of the stock market notices. Right now, you could be thinking, well, I don't have the time to grasp this. And why should I invest anyhow when I can make 2 to 3% by keeping it on a bank on the high side? The answer is pretty straightforward. You can make a lot of money if you do it correctly. If you bought $1,000 of Amazon shares in 1997, you'd have nearly $1.5 million right now, according to a popular example. Although there is a lengthy investment schedule, I believe that most people would agree that the purchase is worthwhile. Other firms provide frequently return rates of 30 to 70% each year, which will still build you a substantial amount of money when compared to the 2 or 3% per year stored in a bank account. In other words, if you can make more than 3% in the stock market, you're doing better with your money than if you put it in a bank. Now that we've established that the stock market is a real-time marketplace where you may buy a piece of a company you believe will flourish, the next step is how to find where to invest. The first thing you'll need is a trading account, which you may open one with E-Trade or other large financial organizations, but you can also utilize free trading platforms like Robinhood. Typical trading platforms demand fees for each deal, but emerging software businesses like Robinhood have made everything absolutely free. This means you may put all of your money into a corporation and not have to worry about paying brokerage fees. After you've opened an account with any trading site, the next step is to determine which businesses or many firms' stocks to buy, which is likely the most difficult portion. You would of course also need a specific amount of cash, because stocks can cost anything from a few pennies to hundreds of dollars. The important thing to remember about stocks is that you can't buy them in pieces. It's either everything or nothing. You'll need at least $1,800 to get started investing in Amazon at the time of this recording, but you may also acquire far less well-rated firms for merely a few dollars. Before making a purchase, you should conduct comprehensive research to ensure that you understand how a company makes money, if they are in good financial standings, and what experts say about the firm in terms of whether you should acquire it. At the end of the day, you must accept some risk. So only invest money you can live without for at least a short period of time, or until a particular stock rises again if it falls on hard times. We did not cover much of the technical research that goes into analyzing a business, much of the vocabularies around stock trading, or even techniques to trade without having the money you're buying stocks with called margin, and that is okay. The greatest approach to learn about the stock market and become engaged is to take little dollars you're willing to lose and get your hands dirty. Then, invest sensibly. And with that, today's video comes to an end. If you haven't already, hit the like button to show your love and support for our video. Also, don't forget to subscribe to the channel and click the notification bell next to it to be the first to know when we have a new video. Thank you very much for stopping by, and we hope you enjoyed it. We hope to see you in another video.